Hello and welcome to another episode of Darwin Investors. Now, before we get started, here is my disclaimer, and I'm being very serious about this. The thumbnail that you hit was not clickbait. I'm being very serious. What I'm about to show you is something that I'm working through, and I'm seriously advising you not to do what I've done. However, I'm sure there's going to be some hedge fund out there that might see this and go, hey, what are you doing showing our secrets for? This is our secret, and here I'm giving it away for free. Don't worry, hedge fund. I've got very few subscribers. I've got very few viewers per video. This is going to be between me, Dave, Bob, retired in 2020, and then probably a few other people. Your secret is going to be safe with us. Now, I did debate doing this video and said I was going to do a video about Tesla, because that's such a polarizing stock that a lot of analysts can't seem to get it right. They're either in one camp or in like another camp, and they can't just objectively look at the company and offer kind of like an unbiased opinion on what the stock is actually worth. So I was going to do a video on that, but instead what I might do is just actually trade that stock using the strategy that I'm going to show here in this video. Now, on the surface, this trading strategy is not something out of this world, really, but if you employ it on the right stock or ETF, you can see it can generate some really nice returns. And it may not give you huge gains. It might not give you a gain at all. It might take a huge loss and turn it into a smaller loss, which is kind of what I'm in the process of doing right now, using this trading strategy. But it was something that I accidentally stumbled across last week. Now, this isn't something that I would have ever been able to do prior to 2022, because 2022, although it's been an awful year by stock market standards, now I've had some fantastic things happen to me this year. Just the stock market wasn't one of them. But this year was an awful year by stock market standards, but it's actually made a lot of us better investors. We have to understand the market better. We know market sectors a lot better. We know that the next time something like this happens, where to take our money from and where to put our money into. We've been forced to get a lot more resourceful. We might be doing this selling options. We might, well, we used to do it by dollar cost averaging down, but now we know, do not dollar cost average down in a bear market. That was so 2021. Actually, 2009 through 2021, you could pretty much just dollar cost average your way out of a bad situation. You can't do that in a bear market. All you're doing is throwing away good money after bad. So we've been forced to understand options and get a little bit more resourceful to kind of squeak out some small gains or minimize our losses. Now, in this video, what I'm going to do is I'm going to show you something that happened to me last week while recording a video, and it was a situation that I got put in because I had some time off and I was doing stupid things in and out of stock. It wasn't that stupid if you're watching the market, but if you're not watching, really stupid. I was doing something else and I got caught with my pants down. All right, so let's go ahead and have a look at this clip and I'll show you what I was talking about. I'm going to continue swing trading. I might be making money right now. I don't know. I've got a trade that's in there. Maybe it's triggered. We'll see. Now, I was off work for a few days last week, and so I could actually go to a casino in Atlantic City, or I go to my favorite casino, which is right here at the table, trading with the old New York Stock Exchange. And what I was doing is I was going back and forth between a couple different natural gas futures ETFs. One was called Boyle, and the other one's called Cold. Boyle would be if you felt that natural gas futures were going to be going up. If you were bullish on natural gas futures, you buy Boyle. If you're bearish on natural gas futures, you buy Cold. Now, both will go up. Boyle will go up if natural gas futures increase, and Cold will go up if natural gas futures go down. So I would buy Boyle, it would go up, and then when I felt that was enough, I would take a little bit of profit, then I would buy Cold, and then I would expect natural gas to go down, but then Cold would go up. The actual stock would go up because it's an inverse leveraged ETF on natural gas futures. So yeah, this was pretty risky stuff, but not so risky if you're just sitting here watching the stock market. Not a big deal. You get up $100, you sell. You get down $50, you sell. It's just like, you're just kind of watching, just kind of having fun. No more crazy than going to the casino and playing blackjack for, $5 a hand or whatever. And so what was happening was I put in a limit buy for Boyle, and I was making a video, and then all of a sudden the price of Boyle, or the price of natural gas futures, collapsed. And it happened while I was making a video. But by the time I published the video to YouTube, I hadn't checked the stock market in hours. So I did actually get a sign. I said, oh, did I get a sign? So I said, yeah, I did get a sign. And not only did I get a sign, I'm down $1,074 on this leveraged ETF called Boyle. It's a double leveraged ETF. So what do I do at that point? Well, there's a couple of choices. Let's go ahead and look into what we could do if we get in a position like that. And that doesn't just apply to my position here, but it could apply to some of your positions as well. Let's have a look at what some of our options are. So we've all been in this position before where we found ourselves down on a certain position in our portfolio. Maybe not in 3 hours while we're recording a YouTube video, but we've all found ourselves a bit down. And then so when that happens, we presented with a few different options that we can take to try and get ourselves out of this situation. Now we can try and dollar cost average down. As we know now in this bear market, dollar cost averaging down, no matter how good the company is, even if it's Amazon or Google, is just kind of throwing good money after bad. Unless it gets way down, then I guess that's decent. But for by and large, dollar cost averaging down has been a loser for those of us that have a limited number of dollars to put into the market. Now, the next thing you can do is you can sell and take a loss. Now, if it is one of these mega cap tech type stocks, you really believe that this company is going to survive this economic recession we're about to have, maybe you don't just sell at a big loss, you just kind of wait it out. If you're in the companies like, say, maybe like a Snowflake or something like that, then maybe you don't necessarily believe in because you've never used their product, you don't exactly know what they do, and you're down a bit, maybe you just cut bait and you go fish somewhere else. And that would probably be the preferred, actually, that's the strategy I prefer over dollar cost averaging down in a bear market, is kind of on those types of companies, just kind of cut bait and fish somewhere else. Lastly, if you do believe in the company or you do believe in the product that you're holding on to, go ahead and sell covered calls contracts. Now you can sell covered call contracts in the money or you can sell them out of the money. In the money covered call contracts are going to give you more money than out of the money covered call contracts. So let's go ahead and look at Boyle and Cold and also look at covered call contracts at the same exact time. As I stated before, Boyle is a ProShares Ultra Natural Gas 2x leveraged ETF on natural gas futures. So what we want to do is we can go ahead and sell a covered call against this underlying ETF. So just go ahead and go here to call, to Boyle, set a strike date, an expiration date of January 6th, so next Friday, and let's have a strike price of $17.50. That's fine. Meaning that's slightly in the money. Meaning that if by January 6th, the price of Boyle is above $17.50, I have to sell it for $17.50, even if the price of Boyle is $27.50. I'm entering a contract. For this, they're going to give me $1.55 per share to hold the contract. Now, each contract is 100 shares, so each contract is worth $155. Now, when we look at this compared to other equities or ETFs of similar value, let's have a look and see how $155 compares to something, say, like Macy's. And again, we'll be selling this call contract that will have an expiration date of next Friday, and we'll do it slightly in the money. And in this one, you get $68. The last one was $155. Let's go ahead and look at Pinterest. Pinterest trades at $24.28. We'll go ahead and sell a covered call contract on this one that expires next week, slightly in the money. It sells at $80. Again, Boyle was $155. Let's look at other leveraged ETFs and see how they trade relative to Pins, Macy's, and to Boyle. We'll look at the Bull Ultra Pro Long triple leveraged on the NASDAQ ProShares. It's currently sitting at $17.30. The contract that expires on January 6th in the money is only $88. So that we can see that when we're looking at Boyle, that this is a pretty powerful tool to have to be able to sell a contract that expires on the 1st of January, slightly in the money, for $155. Now, why is this huge premium so powerful relative to, like, say, a Macy's or even a TQQQ, which is a triple leveraged ETF on the NASDAQ? Well, what gives this such incredible power is that even if at expiration on January 6th, this is trading at $18.50, I still make money. And the reason why has to do because someone has already paid me $1.55 per share or $155 per contract to hold this contract. So at expiration, I have a decision to make. Do I want to keep that extra money, which in this case would be 55 cents or $55, and sell it at $17.50, even if it's 18.50? Or do I want to buy out this contract for $55 and sell it again and keep my shares? And that's the power of this, because at expiration, even at $18.50, I will have the option to buy out this contract for $100, a contract that someone paid me $155 for. I can buy it out for $100, pocket 55, and resell the contract at a different strike price. And this is the luxury that you get from trading a contract such as this one relative to one, say, like the Macy's one or the Pinterest one, where I was getting like $48 or something like that. And so this is a very powerful tool. Now, why is it I'm able to get so much money out of this? Well, this has to do with the concept of intrinsic and extrinsic value. Now, for this example, let's go ahead and look at the contracts that I have open right now at this time. And then after I show you what I have open and show you my strikes and expiration date, we'll go into intrinsic and extrinsic value. So as I stated before, I have some contracts open, some that I closed out. I have JP Morgan, Advanced Auto Parts, Moderna, and Boyle open. I've sold covered calls. That's what the C is for. It's for call. You know that I've sold it because it's minus signs. I have a contract or 4 contracts on Boyle here with a strike price of $18 by January 6th of 2023. You can see I sold them for $700, and I sold them for $720, but after Schwab takes their little cut, it's $717.33. It's currently worth $530. I'm currently up on the position $187.33. And so what are my options with this? Well, okay, so I've got Boyle here, and it's got a strike price of $18 with an expiration date of next Friday. I sold it for $720, which would be $180 per contract, which means that provided that Boyle is below $19.80, I break even on this. You know, I just let it sell and I don't really care. Now, if Boyle starts going way down, you know, down the line, then what I want to do is I want to roll this down. I want to cash out. Like right now I can cash out for $187, but let's say that Boyle, instead of being $17.87, goes to like $16.75 or something like that. Suddenly I'll be able to get about $400 on this, and then I can resell it with another lower strike of $16. And I'll be able to do it with a very high premium because this is such a volatile stock. It trades with a lot of what we call extrinsic value, a lot of volatility. So let's go ahead and look at intrinsic and extrinsic value. Now let's take the example of Boyle, which I just gave. Every contract has an intrinsic value and an extrinsic value. The intrinsic value is the value applied to those shares at the time of expiration. At expiration, there is no extrinsic value. All it has is intrinsic value. And I'll get into an example about this in just a second. Extrinsic value is derived from the volatility that the share carries, or the stock or ETF carries, and that's also known as vega. Another part of extrinsic value is going to be called theta, or time to expiration. I like to sell options with hardly any time because what happens is that the buyer runs out of time and I want the buyer to run out of time. So you want to sell options with no time and you want to buy options with lots of time, sometimes called a leap. So let's go ahead and get into, just to paint a better picture what intrinsic and extrinsic value is at the time of expiration. Let's go back to this Boyle example. So let's say that instead of $17.50 at expiration, because we can clearly see that $17.50 is lower than $17.78. So right now, if it finished out this week, I would have to sell these shares for $17.50 a piece, even though it's $17.78. That gives this option here 28 cents per share, or $28 of intrinsic value. The remaining $127 of this contract is all extrinsic value. It's time to maturity and its volatility. If we look at it in the money here, or out of the money, excuse me, if we look at it out of the money, the entire $133 we see here, there is no intrinsic value to this. $18, if it finishes at 1778 next week, and the covered call is for $18, I keep all of their money. So every bit of this is extrinsic value. There is no intrinsic value for this. This option is worth nothing at expiration to the buyer. It's worth $133 to me as the seller. And so that's the difference between intrinsic and extrinsic value. So why would Boyle trade at such a high premium relative to Macy's? Well, that has everything to do with the fact that Boyle has a lot more extrinsic value than Macy's has, because everybody's intrinsic value relative to the strike price is exactly the same. So today I sold Boyle for it was trading at roughly $18.56. I sold it for $1.70, and the strike price was $18 with a January 6th expiration. So 56 cents of that was intrinsic value, and the other $1.24 was extrinsic value, which is time plus volatility. And this is really powerful because it gives me a lot of options at the time of expiration. At $1.70, I don't start losing money unless Boyle goes over 1970. However, it is very volatile, and I've got to watch it like a hawk, because if it starts plunging, I want to take my gains, and then I want to resell another contract at a lower strike price. Now, I teased the topic of Tesla, so let's go ahead and see what would happen if we sold a covered call on Tesla. If we decide we want to buy Tesla, and we think that 123 is a top. Now, Tesla's a scary one, because all Elon Musk has to do is come out next week and say these 5 words: I found a CEO for Twitter, and Tesla's going to go to the moon. However, let's just say that you bought it today at this price, and the very first thing you did was sell a covered call with a strike at the money at $123. Well, this thing is going to pay you right away $668. Just to sell this call. What that means is that provided by Friday, Tesla's say below $130, you don't lose any money. Like, let's say that you have to sell it for $123 and Tesla's at $128. Well, you made about $150 on Tesla. Now, but you're not really sure, because Tesla's really volatile. It could go up and it could go down. Let's say it goes down to say $115. Well, you get to keep all your money, and then you can sell another call against Tesla. And I'm guessing this is what a lot of big hedge funds do. They take these ultra volatile stocks and that trade with this huge premium to like, if you look at another company similar to Tesla, let's say Apple, like similar in price to Tesla, it's not going to sell at the same price as this. Let's see, a call for $129 that expires next week. It's $300. And that's further, and this one's further in the money than Tesla was. So it trades at half the price of Tesla. And so this is the power of taking something super volatile and selling a call against it if you believe in the company. Now, Tesla at 123, I think there's a good chance it goes down. I mean, that's just me, but I think there's a good chance it goes down for there, provided it doesn't hire another CEO for Twitter. So let's apply this method to a stock. Okay, like I said earlier, that I accidentally bought, well, I bought it on purpose. I would have actually sold it at about 23 bucks, or just if it dipped under 23, I would have sold these shares and taken the loss at that point. But by the time I checked back on the stock, it was like 21 bucks. So I was way down on these things. So I bought 400 shares at $23.86. If I include the options now, you can see that I've been trading in and out of this sucker like crazy to try and bring down my my original price. So like every time you sell an option, you collect money, it brings down your cost basis on the stock. So I bought it for $23.86. Like I said, I was trading in and out of it, that and cold, and I made some money on cold, and I lost a little bit on Boyle at the time. But at the time, I think I was up about $100 on the two, just kind of sitting around here at the table, just screwing around. But this wasn't screwing around, because I ended up down about $1,074. So let's go ahead and see where I bought it for and what my cost basis is today after, you know, all of these options that I traded. So I bought it for $23.86, and I bought 400 shares, and so it was $95.44. Now, every time you see a plus sign here, this is me selling it. And every time you see a minus sign, this is me buying it back. So I sold it for 425 and I bought it back for 242. And just to save you all the time, I'm just going to run through all these numbers and let you know what my new cost basis is. So my new cost basis is $19.36 a share. So I've been selling covered calls on this thing like crazy, and it's brought my cost basis down from $23.86 a share down to $19.36 a share. If we look at my history this week, let me look at my realized gains and losses this week. I have no idea what they are. It looks like this week, well, the website's screwing up. I would have liked to have shown you individually what I was doing, but it looks like this week from 26th through the 30th, I've made $1,232 just trading options, which is a pretty good week for me, and mostly due because I'm just kind of getting into Boyle. Now, granted, I'm way down on the underlying shares, but I'm not really nervous. Like if natural gas isn't going to zero, at least maybe I hope it does. I'll save a lot more money than $500 over my lifetime. But if this thing should go to the moon over the weekend, let's say it like goes to $30 a share, I'll be sad that I didn't get that because I have this contract that says I'm going to sell it for $18. I don't think it's going to, but if it does, I'll end up losing about $540 on this, and that's better than losing the 1,074. Now, I do think this is very interesting here. I did notice this, and this is just one of these things. I made another video on this, but this is kind of the way that the market kind of is manipulated to some degree. If you look at JP Morgan and Advance Auto Parts, I actually bought my way out of these things earlier. I did make a little bit of money. I want to say it was like $10 on JP Morgan and like $20 on Advance Auto Parts. But the thing that I think is really interesting about these stocks is where they actually finished the week at. Again, if you look at my strike prices here, you can see that it was 134 for JP Morgan and a strike of 147 for Advance Auto Parts. If we look and see where they finished the week at, Advance Auto Parts was 147.03 and JP Morgan was 134.10. These things really close to right on the target right here. This is not an accident. This is the power of payment for order flow. It's the reason why Ken Griffin over there at Citadel can make so much money. We're all playing a game of poker. They can see our cards, but we can't see theirs. If you're all right with this, then go ahead and trade options. Just kind of understand that this kind of happens. And that's why Advance will finish, just above something. Maybe they sold puts at 147. They didn't want the shares. Maybe they have covered calls at 140, that they're buying at that they bought for 147 and they want to buy it for 147, and so they want someone to drive the price up so that they can get a slight discount to the shares that they'd like to purchase. Whatever. Just know that these things ending so close to these strike prices, it's not an accident. And I had one at 147 at one and one on JP Morgan at 134, and I'm guessing a lot of people did. It's the reason why I advocate for like taking very small profits. So like, let's say you get up like 50% on a position, just take the money. They're gonna take it from you if you don't get it first. So make sure you get them before they get you. That's just my advice, having done this for like about a year now. All right, so if you got anything out of this video, yeah, please like, subscribe, hit that little notification bell. As a matter of fact, I'm sure the hedge fund would like to see you unsubscribe. They don't want to see me giving this information out for nothing. But again, I'm not telling anybody to do anything. I'm just saying that this is what I do. I'm not telling anybody to buy anything. Don't get mad at me and put down in the comments if you lost your shirt selling call options against double leveraged natural gas future ETFs or what have you. But until then, we'll have a great day and we'll see you next time. Happy New Year. Bye.